Welcome back. Let us now start with the first part of our main part of our lesson. Now, we will be looking into factors that should be considered when making an investment decision. To say, what should you think about before you can decide on the best investment for you? Now, investment decisions. The first part is to think about return on investment, to say how much are you going to get from the investment? What is the interest? What is the dividend? What is the capital gain for that investment opportunity? So this refers to what you will get in return from investing. So generally, there is a link, or there will be a direct link between risk and return. You should know that the higher the risk, the higher the return. So meaning investment opportunities with higher risk will get you more return. Then, higher risk investment would yield you higher return. For example, investing in shares, which means investing in a company, can be higher risk, but it comes with high returns. So that is the first factor to think about: return on investment. How much are you going to get from the investment? Another aspect to consider now is your investment period. This refers to the duration of the investment, which may influence the return on investment. To say, do you want to invest for 2 years, 3 years? You should think about that as well. Hence, we call these aspects factors to be considered before making an investment decision. So one thing you should know is that the longer the investment period, the higher the return, because you'll get interest for more years as you have invested for a longer period. So hence we talk about the time here, the duration. And then we move to another aspect to consider, which is inflation rate. Remember, inflation refers to the general increase in the prices of goods and services. So when we're talking about the return, we're talking about the idea that now, when we are talking about inflation, we are talking about the idea that now inflation will now have an impact on the capital amount and the return that has been invested, because the power of, or the value of money would have changed due to what now? The inflation, due to the idea of the general increase of prices of goods and services. Remember, the 50 Rand value for 2010 is not the same for the 50 Rand value for 2050, because whatever the 50 Rand was able to buy in 2010 will not be able to buy in 2050. Hence, we are talking about inflation. So the return on investment should be higher than the inflation rate, so that now you know that your return will be good and will not be affected by inflation. Another aspect is that inflation has a positive effect on some investments, such as property, because these will lead to the property price increasing. It will lead to the property gaining value. Another aspect you should consider is risk. Risk refers to the chances of losing the amount you have invested in total or some parts. So when you're looking into that, is to say, now when you look into investment opportunity, think about the risk associated with each investment opportunity. For example, when you are looking into shares have low or medium risk over long term when you're looking into the investment period. Another aspect about shares is that shares with high risk have a greater potential for higher returns. We talked about that when we are addressing return on investment. Another aspect to consider now is taxation. To say, some investment will be taxed. So when you're looking into that factor, you should be thinking about this. To say, a good investment will yield a good after-tax return. This is to say, when you are getting your return, when you have invested, your investment should give you a good after-tax, meaning after your investment interest has been taxed, it should also give you a good value of return. Now, another aspect to consider when you're looking into your taxation is the issue of the tax rates. To say now, tax rates are not necessarily the same for the different investments. When you are investing in property, you should think about it to say, how much is the tax rate for investing in property? When you want to do maybe fixed deposit with the bank, you should also consider how much is the tax rate, so that you know how much you will lose from tax, so that you make an informed decision. Now, another aspect to consider is your liquidation. Liquidity. Another aspect to consider is your liquidity. Now, it has to do with the rate at which the investment can be converted into cash. Now, it is used to describe the ease and speed with which investors can convert an investment into cash. So here we are talking about this, for example. If you invest in fixed property, meaning in buying a house, will it be easy to convert a house into cash in 10 days? That won't happen. Meaning the liquidity rate for converting an investment in property into cash is slower. Hence, we are talking about how easy and the speed with which the investor can convert an investment into cash. Because here we're talking about the idea that an investment is when you are taking your money and putting it into an asset or putting it into a bank. So when you are taking it and putting it into an asset such as property, a house, you should know that the liquidity to convert your amount that you have invested into cash will be very slow, especially when you're looking into property. But when you look into maybe other investment opportunities, such as, for instance, a 32 days notice account, you know that if you have invested using that investment opportunity, it becomes easy to convert your investment into cash because you will have to wait 32 days before you can get your investment back into your bank account. Hence, we are talking about investing and we are talking about converting your investment from the investment to cash, meaning from the investor to your bank account. So that's what we mean. We are talking about the conversion rate to say how fast will it happen. So with that being said, let us take a short break and we'll come back and address the functions of JSE.